The US government is expected to borrow $2 trillion a year for the next decade. That's huge and unprecedented. Investors are starting to think that all this borrowing could have some major impacts on stocks, bonds, and all kinds of other investments. I'm going to explain why the government is borrowing so much money, why all that borrowing will impact markets, and what this could mean for the investing world in the near future. Let's get into it. The US national debt recently hit $33 trillion, and the Congressional Budget Office estimates our debt could surpass $40 trillion in 5 years. That's because, even though the government isn't rolling out any big new stimulus programs, it is bringing in a lot less revenue than it did over the past 2 years. Revenue is basically shorthand for taxes. The government is collecting less taxes because people are collecting less capital gains on the sale of things like stocks, businesses, and houses. Remember, you pay taxes in the year following taxable events. So the taxes from big stock and housing market gains we saw in 2021 were largely recorded in fiscal year 2022. The government is also paying a lot more in interest so it can borrow money to pay for the deficit. The interest rate on 2-year government bonds at the beginning of 2022 was less than 1%. Now, that rate is over 5%. When you're paying interest on billions or trillions of dollars in debt, that difference adds up. Jefferies US economist Thomas Simons is expecting the government to issue just under $4 trillion in medium and long-term debt in fiscal year 2024. And it's going to have to sell that debt at the same time that some of the largest buyers are cutting back. The Federal Reserve is the largest holder of Treasury bonds, but the US Central Bank is projected to reduce its holdings by up to $60 billion per month moving forward. And the latest report from the Treasury Department shows China cut its holdings of US government bonds to the lowest level since May 2009. China was the largest foreign holder of US government debt as recently as 2019, and held more than $1 trillion in treasuries in early 2021. But the country has reduced its holdings by almost $300 billion since then. When there's more supply and less demand, that usually means that prices fall. For bonds, it also means that yields rise. Treasury yields reached their highest level in more than 15 years in September, and the mountain of new debt that's coming could push them even higher. Higher yields historically increase the value of the dollar and boost the attractiveness of safe assets like money market funds. Retail traders and professional money managers have pushed a record amount of cash into money market funds, which are paying the highest interest rates in decades. Higher yields also have made investments in risky assets like stocks less attractive. The thinking goes that if you can get a guaranteed 5% return on an asset that's a lot like a savings account, why take the risk on stocks? And because most public companies have to borrow money by issuing bonds, their costs will go up, which often makes them less profitable. This is especially true for so-called growth stocks. These are usually tech companies that have very high market valuations, even though they don't make a lot of profit. Tech has made up an increasingly large share of the benchmark S&P 500 stock index and is the backbone of the NASDAQ. With the outlook for the economy uncertain, you could see more investors start to favor parking their money with the US government or leaving it in money market funds.